How did the legendary Peter Lynch manage to stay on top of the market during his whole career? How did his fund survive significant downturns such as Black Monday? Well, the answer lies in his investing philosophy and strategies. Today, we're going to clue you into the secrets to maximizing your profits in 2023 with advice from the man himself. Peter Lynch is a widely respected name in the game of finance. In 13 years as the manager of Fidelity's Magellan fund, he grew the assets from $18 million to a whopping $14 billion. This was fueled by his keen understanding of the market's future, and this is clearly evident by the 29.2% annual return he averaged during his time. We've collected a handful of insightful, powerful advice from Peter Lynch over the course of his career. As you might guess, many of these interviews were done after he had found great success, so his words are tried and true. So let's not waste any time so you can get straight into making money. And here's our first gold nugget of wisdom from the ex-Magellan fund manager.
People understand there's a 100% correlation with what happens to a company's earnings over several years and what happens to the stock. If the company, McDonald's, has done very well as a company,
right,
the stock has done very well. People worry about too much money supply, what's happening to the price of oil, whether, who's the president, who's being nominated for the Supreme Court,
it's all
the
earnings.
ozone layer. There's nothing to do. McDonald's earnings go up the next 10 years, the stock will go up.
Yeah, but what they will say to you, Peter, is that, as you know, and why am I telling you this, but it's fun to tell you this, they're telling you that these other things influence the amount of earnings of a particular company.
Yeah.
If we're in a recession, people are not going to spend as much money on going to the movies or whatever they do.
Right.
And therefore, you got to pay attention to these other things because they impact on earnings.
They are very important, but you have no idea of knowing what they're going to do. Alan Greenspan's the head of the Federal Reserve.
Right.
He cannot predict interest rates. He'd be the first to tell
He can
you.
influence them, but he can't predict them.
He cannot predict what long-term interest rates are going to be 1 year from now, 2 years from now, 3 years from now. He's even surprised how low they are now. So how am I supposed to predict interest rates? How am I supposed to predict the economy? You certainly remember the recession of 82.
Yes.
In 1982, we had a 20% crime rate, 14% unemployment, 12% inflation. I don't remember anybody telling me in 1980 or 81 that was going to happen. All of a sudden, we had the worst recession since the Depression. I didn't read about it in the paper. So it's crazy.
Peter's main point here is that your main focus when purchasing stocks should be the company's likelihood of making a profit. When it comes down to the wire, a company's share price is a reflection of investors' confidence that it will continue to increase its earnings. There are several factors that can contribute to a company increasing its profits year over year. You can worry about the latest fear-mongering on the news, or you can adopt a laser focus on the actual business strategies that your prospective purchase is engaging in. So here are three worth considering. Number one is expanded product or service offerings. A company can increase its profits by expanding its product or service offerings. This can involve introducing new products or services or expanding into new markets. Number two is stronger pricing power. A company can increase its profits by increasing the prices of its products or services. This can be achieved through a variety of methods, such as improving the perceived value of the product or service or increasing demand through marketing efforts. Number three is reducing expenses. A company can increase its profits by reducing its expenses. This can involve cutting unnecessary costs, negotiating better deals with suppliers, or finding cheaper ways to produce goods or deliver services. Just cut out the noise and focus on what really matters in terms of a company's earnings. Now, on to Peter's next point.
Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. If anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, there can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. A lot of people in this room were around in 1981 and 82, when we had a 20% prime rate, with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I studied all this stuff. I don't remember anybody telling me we're going to have the worst recession since the Depression. But I'm trying to tell you it would be very useful to know what the stock market is going to do. It would be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, our interest rate is going to be 12%. That's useful stuff. You never know it, though. You just don't get to learn it. So I've always said if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that.
Peter makes yet another blunt point in this clip. Macroeconomics, including things such as inflation and interest rates, are affecting the market but should not affect your choice of company. Assuming you're investing in a company that is not teetering on the brink of bankruptcy and will be around in 5 to 10 or more years, then you should stop letting these macroeconomic indicators scare you away from purchasing a great stock. Despite poor interest rates and inflation in the market, it can still be worth buying a stock with great potential for several reasons. Even if interest rates are low, a company with strong potential for growth can still generate significant returns for investors. If the company's profits and revenue are increasing, the stock price may rise, which can provide a good return on investment even in a low interest rate environment. Secondly, while inflation can erode the purchasing power of cash, it can also lead to higher prices for goods and services. This can be beneficial for companies that are able to pass on higher costs to their customers. Essentially, it's important to consider the long-term potential of a stock rather than just focusing on short-term market conditions. While interest rates and inflation can impact the market in the short term, the long-term growth prospects of a company are more of an important factor in determining its potential as an investment.
We had a huge run. I mean, the market was 4,000 just 2.5 years ago, and it ran up to 8,300 in August. And like any big rally, sometimes it backs off, and it's healthy. In fact, I'd rather gone down 1,000 points than gone to 12,000. If you look at Japan went from 5,000 to 15,000 on their Dow, and it was fairly priced at 15,000 on earnings and everything else. Then it went to 40,000, and that caused 7 years of inflated real estate, people overspending, and basically they've been in a recession for 5 or 6 years because their market went up too high. If the market goes too high, you're discounting earnings 7, 8, 10 years out.
Once again, Lynch has some reassuring words for us. As we watch our current market take plunge after plunge, it can be anxiety-inducing to think about owning any stocks at all. But as he points out, a dip in the market, even large ones, are healthy for future profits. When an economy gets too ahead of itself, investors follow. Then when valuations far outpace reality, it comes crumbling down and the losses can take far longer to recuperate. Corrections can help to reduce overvaluations in the market, which can help to prevent such a bubble from forming. However, we're talking profits here, not just avoiding losses. Corrections can create buying opportunities for long-term investors, and when the market experiences a dip, the prices of stocks may fall, creating an opportunity for investors to buy shares at a lower price. This can be especially attractive to long-term investors who are looking to hold onto their investments for a longer period of time. Overall, while corrections can be unsettling for investors, they can help to create a healthier and more stable market in the long run. So you could say that we have a market full of opportunities at the moment, even with as low as things have dropped. So how do you know what stocks are worth picking?
We could take a coin out and flip it. I have no idea what the next 1,000 points are going to be. The next 6,000 points are going to be up. The next 14,000 points are going to be up. The next 20,000 points are going to be up.
But you don't know what the next 1,000 is going to be. It
Nobody
could be
does.
down, could be up.
Nobody does. And it's futile to try and guess it. Corporate profits will be a lot higher 10 years from now. They'll be a lot higher 20 years from now. That's what you could rely on. Microsoft didn't exist 20 years ago. Staples didn't exist 20 years ago. Federal Express didn't exist 20 years ago. New companies will come along. That's what makes stocks
didn't exist 20 years ago.
That's what makes Amgen has 2 $1 billion drugs. They didn't exist 20 years ago. New companies will come along. That's what makes this country work. All these public companies out there, here's the company I really like. The fundamentals are terrific. Their earnings are doing well. The competitors are doing poorly. I think this company's doing terrific. And all of a sudden, the stock might have gone from 40 to 30 because of this decline. That would say, wow, here's a chance to buy it. So you're trying to say some companies might have been overpriced at 60 and all they did was go to 50 and you say, big deal. So you're trying to find companies you like anyway. Right now you like them. And now they've had a haircut. That's what you would do. Not a stock that went from overpriced to fairly priced. Something that was fairly priced at the start of this exercise and then had a very, 5-for-4 sale. You say to yourself, I think this company's going to earn something in the future. If it's already discounting that, if it's selling at a huge multiple, you say it has to work, and then it's only going to stay even. So you have to say to yourself, if I'm right, how much am I going to make? If I'm wrong, how much am I going to lose? That's the risk-reward ratio. In Stock Shop, we talk about, if I'm right, I hope I'm going to double, triple my money. If I'm wrong, maybe I'll lose 30, 40%. That's a favor ratio. You say, if I'm right, the stock's not going to go up. It's already discounting terrific things. If discounting terrific things are already in the stock, I don't know.
Okay.
The basic idea that Peter Lynch is trying to get across here is that you need to be selective about the companies that you purchase while still acknowledging that you don't know exactly how it will play out. There are probably many companies in the United States at the moment that may be poised for a great run that could last years or even decades. So when you find some potential stocks to buy, carefully consider how much money you stand to make and how much you could lose. Find a risk-reward ratio that you're comfortable with. If you do your due due diligence in terms of research and evaluation, as well as being smart about how much risk you take on, you can grow your profits steadily over time. Hopefully, you've been taking Peter Lynch's advice into consideration throughout this video. These tips and principles will lead you to steady and dependable financial success in the long term, as long as you stick to your guns and implement strategies with focused intent. For more advice on maximizing your profits, we highly recommend our past video on Dave Ramsey's 5 tips for making yourself super wealthy. But thanks for watching, everybody. If you would like to support our future videos, simply liking this video and subscribing to our channel allows us to continue creating educational and entertaining content that will protect your profits. But until the next one, we'll be seeing you.